Welcome to Yadnya Investment Academy. Through our fund analysis series, we have reviewed some of the most popular multi-cap funds, and in this video, we are going to compare all of them. Now before we get started, a small brush up. Remember, multi-cap funds are suitable for an investment duration of 5 to 10 years. A reasonable returns expectation from such funds is 10 to 12% on a per annum basis. Now in this video you would see that funds have given returns of over 12% on a per annum basis over 5 to 10 year duration. But returns of 10 to 12% is a realistic expectation from these funds. In this video we are going to compare Birla Sun Life Equity Fund, Reliance Equity Opportunities Fund, ICICI Prudential Value Discovery Fund, Franklin India Prima Plus Fund, HDFC Equity Fund and Kotak Select Focus Fund. All the data has been taken as of 20th June 2017 and all the risk return parameters like mean, standard deviation, beta, R squared, alpha, Sharpe ratio have been calculated using calendar month returns for the last 3 years. Now all these funds have different benchmarks. Birla Sun Life Equity Fund has S&P BSE 200 as its benchmark. Reliance Equity Opportunities Fund has S&P BSE 100 as its benchmark. ICICI Prudential Value Discovery Fund has S&P BSE 500 as its benchmark. Franklin India Prima Plus Fund has Nifty 500 as its benchmark. HDFC Equity Fund also has Nifty 500 as its benchmark. And Kotak Select Focus Fund has Nifty 200 as its benchmark. For simplification purpose, we have selected Nifty 500 as a benchmark to be compared with all these funds, as Nifty 500 is a broader index and is suitable for multi-cap funds. Now the average returns, that is the mean of all these funds, is better than the benchmark Nifty 500 and also better than their individual benchmarks. Standard deviation is the amount by which the returns of a fund may go up or down in correlation with its mean. So a greater standard deviation indicates that the fund is more volatile. Now ICICI Prudential Value Discovery Fund and Franklin India Prima Plus Fund have a standard deviation which is below than that of the benchmark and also their individual benchmarks. The rest of the funds seem to be more volatile than the individual benchmarks also in comparison with Nifty 500. The beta value indicates the correlation of the fund with that of the index. A beta value greater than 1 indicates that the fund would gain more when the index moves up in the market rally, and the fund would fall more in comparison with its index when the markets move down. An R squared value indicates how reliable is this beta. A value equal to 0.8 or greater than 0.8 is what is desirable, and here all these funds have an R squared value greater than 0.8 except Reliance Equity Opportunities Fund and ICICI Prudential Value Discovery Fund. But these values are almost close to 0.8, so we can consider them and move ahead. And alpha tells you the amount of returns produced by a fund over and above the ones predicted by its beta value. So here Reliance Equity Opportunities Fund and HDFC Equity Fund have not been able to produce a sizable alpha, whereas all the other funds have produced an alpha above 7%. Sharpe ratio is a single figure which tells you the risk return correlation of a fund. So value greater than 1 is what is desirable. Franklin India Prima Plus Fund and Kotak Select Focus Fund have a Sharpe ratio greater than 1, indicating that these funds are taking less risk. At the same time, they're able to pull out more returns from the risk they are taking. Nifty 500 has a better Sharpe ratio in comparison with all the other benchmarks these funds are benchmarked against. So Nifty 500 seems to be a good reference point, and when we compare the Sharpe ratios of all these funds with Nifty 500, Reliance Equity Opportunities Fund and HDFC Equity Fund seem to be very risky funds. Now the P ratio indicates growth potential of a fund. So if the P ratio of a fund is below than that of the benchmark, it indicates that the fund has growth potential. All these funds have a PE ratio below than that of their individual benchmarks. Reliance Equity Opportunities Fund, on the other hand, has a PE ratio higher than that of its individual benchmark, indicating that the portfolio of this fund is overvalued. But again, PE ratio is a temporary figure. The moment your portfolio changes, the PE ratio would also change. The turnover figure indicates the percentage of a fund's portfolio replaced in the last 1 year. A value below 50% indicates buy and hold kind of a strategy of a fund. A value above 50% indicates higher turning of the portfolio, but you should be bothered about this figure only if a higher turning of the portfolio is not able to produce good returns for you. So when we look at the returns of Birla, Reliance and ICICI funds, if these funds are able to pull out returns after turning of the portfolio, we should be good with it. An expense ratio tells you the amount of fee charged by a fund annually for managing your money. It is a percentage of total assets managed by a fund and is directly taken from the profits it makes. So a high expense ratio indicates lower profits for you. But the difference of expense ratio of all the funds we are considering is not too much. So we should concentrate more on returns. If a fund is able to produce returns with a great amount of difference than its peers, we shouldn't be bothered about the expense ratio as well. A higher amount of asset under management indicates higher amount of trust the investors have in the fund. HDFC Equity Fund has the largest AUM in the equity category, but at the same time, all these funds here are among the top 9 in the multi-cap category. Let us look at the trailing returns. The trailing returns indicate the returns produced by a fund backwards from a reference date. All this data has been taken as of 20th of June. So 1 year of trailing returns indicate returns produced by a fund 1 year backwards starting from 20th of June 2017. All these funds have produced good amount of 5, 3, 7 and 10 year trailing returns as compared with Nifty 500, where 5, 7 and 10 year trailing returns of ICICI Prudential Value Discovery Fund are almost 7% ahead as compared with Nifty 500. 1 year trailing returns of Birla Sun Life Equity Fund have been good, where HDFC and Kotak funds are also not far behind. 1 year trailing returns of Reliance, ICICI and Franklin funds have been below than that of the benchmark Nifty 500, but as these are trailing returns, these figures could change in some time. A recent good performance of a fund may improve all the trailing year returns, so it is important to look at the calendar returns as well. Average market capitalization of a fund is the average of market caps of all the stocks held by a mutual fund. When this figure compared with that of the benchmark may give you an idea of holdings of a fund. But as this figure is just indicative, we've put the exact holdings of a fund over here. And as these figures are percentages, it would be fair to compare it with Nifty 500 and not individual benchmarks. And as you can see, Nifty 500 holds more than 78% of its portfolio into large cap stocks. And when you compare the values of all these funds, you may see that Birla Sun Life Equity Fund and Reliance Fund has a greater percentage of mid-cap holdings. Again, Reliance Equity Opportunities Fund had a Sharpe ratio below than that of Nifty 500, indicating that the fund is slightly riskier. Birla Sun Life Equity Fund also has a higher holding into mid-caps, but it is able to contain the risk, which is evident from its Sharpe ratio. Again, market capitalization and these holdings are a temporary figure but can still give a fairer idea of the kind of holding pattern a fund follows. Let us talk about the fund managers now. Birla Sun Life Equity Fund is managed by Anil Shah since 4.7 years. He is a CA and a cost accountant with 24 years of experience into equity. He manages Birla Sun Life India Gen Next Fund, which is also a very good performing fund. Reliance Equity Opportunities Fund is managed by Shailesh Rajbhan since inception. He is an MBA and a CFA. He manages two other Reliance funds, which are Reliance Top 100 and Pharma Fund. The Top 100 fund is an above average fund and the Pharma Fund is a very well performing fund in the long term. Reliance Equity Opportunities Fund under his leadership since inception has given returns of 19.03 on a per annum basis. ICICI Prudential Value Discovery Fund has a staff fund manager in Mrinal Singh who manages the fund since 2011. He is a BE and an MBA. He also manages ICICI Prudential Mid Cap Fund, which is an average performing fund and has a small size. Franklin India Prima Plus Fund is managed by Anand Radhakrishnan and is assisted by R. Janakiraman. Anand is leading the fund since last 10 years and is a BTech and an MBA. He is also a CFA. Franklin Blue Chip Fund managed by Anand is large cap fund, which is one of the biggest and constantly performing fund. Another fund that he manages is Build India Fund, which has performed very well as compared with the category average. Another fund manager, R. Janki Raman, is a small and mid-cap expert. He has joined the fund in 2011. He is a BE and an MBA. He leads Prima Fund, which is a mid-cap fund of the fund house, and a smaller companies fund as well, which are category toppers over the long run. HDFC Equity Fund is led by celebrity fund manager Prashant Jain. He manages the fund since 2003. He is a BTech and an MBA. He is also a CFA. He manages HDFC Prudence Fund, which is a balanced fund, and Top 200 Fund, which is a large cap fund of the fund house. These funds have given consistently good returns over the long term. Kotak Select Focus Fund is managed by Harsha Upadhyay. He is managing the fund since 2012. He is a BTech and an MBA and also a CFA. He manages Kotak Opportunities Fund, which has a similar portfolio and performance. While working with UTI Mutual Fund earlier, he managed UTI Top 100 and UTI Opportunities Fund, which did very well in his tenure. Let us look at the calendar returns of each of these funds. Birla Sun Life Equity Fund does well in bull markets like in the years 2005, 2007 and 2014. And it fails to control its losses, which is evident from the returns of 2011, and in the years 2008 and 2010, the fund was not able to beat its own individual benchmark, which is S&P BSE 200, by a small margin. But since the entry of the new fund manager Anil Shah in 2012, the fund has been doing really well, where it was able to control its losses in 2015, and the year 2016 was so good for the fund that it was able to beat the benchmark by over 10%, where its peers were able to beat their benchmark by only 3 to 4%. So a slightly higher allocation to mid-caps, where the risk-return parameters also indicate the impact of including mid-caps on the higher side, but at the same time good returns generated since inception, that is 24.9% of returns generated on a per annum basis since August 1998, and steady returns since 2012 make this fund an average risk fund, but a good choice for aggressive investors looking for slightly higher returns within the category. Reliance Equity Opportunities Fund produced good amount of returns when the markets were bullish, but in the years 2008, 11, 13 and 15 when the markets moved down, the fund was able to produce just average returns. 2016 was not a good year for the fund, and the trend seemed to have continued, and that is why one-year trailing returns of the fund are below than that of the benchmark. A beta value greater than 1, higher concentration of mid-caps than the benchmark and peers, and a low Sharpe ratio indicates that the fund is taking higher amount of risk and is not able to produce the kind of returns expected. The diversification of the fund is also average. All this indicates that the fund is an above average risk fund. Ignoring the bad initial years of 2006 and 2007, there has been no looking back for ICICI Prudential Value Discovery Fund. What can be noted from the calendar year returns of this fund is that the fund does really well when the markets rally, but it is also able to control its losses when the markets move down. Great returns in case of market rallies is due to the kind of strategy the fund adopts, which is pick stocks trading at a discount. The fund sharply moves across market capitalization based on valuations of stocks available. The fund has a lower standard deviation, and also the beta value of the fund is below 1, indicating that the fund is less sensitive as compared with the index. All this put together with good calendar returns and trailing year returns make ICICI Prudential Value Discovery Fund a below average risk fund, good for any investor as the fund takes calculated decisions. Franklin India Prima Plus Fund has a beta value below 1, indicating that the fund would gain less when the index gains and the fund would fall less when the index falls. This is evident from the returns of 2007 and 9, where the fund lagged behind when the market rallied. At the same time, it fell less than that of the index in the years 2008, 11, 13 and 15. This approach of the fund has kept it steady in the recent challenging years of 2015 and 16. So overall, a steady fund with low risk. Low risk can be evaluated from the Sharpe ratio of the fund, which is 1.07, indicating safe bets taken by the fund. This fund would give you good returns, if not extremely good, and would be a good choice for conservative investors. HDFC Equity Fund has a beta value of 1.17, indicating that the fund is more sensitive than that of the index. This is evident from the calendar year returns, where the market was almost close to the index, if not below, when the markets fell, and again gained more when the markets moved up. This makes this fund a high-risk fund. The fund is the biggest equity fund in India, which could also be the reason why the fund is not performing well, as it has to manage a huge AUM. The fund has given returns of around 20% since its launch in January 1995. Kotak Select Focus Fund is not a very old fund and has not seen the market fall of 2008, but it was able to control its losses in the years 2011 and 2013. It also participated in the bull run of 2014. The fund has beaten the benchmark by 4 to 5% in the testing times of 2015 and 16. The Sharpe ratio of the fund looks good with a value of 1.14. A beta value of 1 indicates that the fund would gain and fall in tandem with the benchmark index. A turnover of almost 0% indicates the confidence the fund has in its bets taken. The fund has beaten the benchmark in all trailing and calendar year returns since launch. As the name suggests, the fund takes bets on specific sectors which are likely to perform at a given point in time. All this put together makes Kotak Select Focus Fund a below average risk fund suitable for a conservative investor. Let us look what would be the value of 6 lakh rupees invested in each of these funds through an SIP of 10,000 rupees each month for the past 5 years. The value of investment of 6 lakh rupees in Birla Sun Life Equity Fund would be 10.82 lakh rupees. In Reliance Equity Opportunities Fund, it would be 9.11 lakh rupees. In ICICI Prudential Value Discovery Fund, it would be 10.15 lakh rupees. In Franklin India Prima Plus Fund, it would be 9.76 lakh rupees. In HDFC Equity Fund, it would be 9.53 lakh rupees. And in Kotak Select Focus Fund, it would be 10.57 lakh rupees. The compounded annual growth rate in case of this SIP, in case of Birla Sun Life Equity Fund, would be 23.38%. In case of Reliance Equity Opportunities Fund, it would be 16.43%. In case of ICICI Prudential Value Discovery Fund, it would be 20.77%. In case of Franklin India Prima Plus Fund, it would be 19.18%. In case of HDFC Equity Fund, it would be 18.02%. And in case of Kotak Select Focus Fund, it would be 22.43%. Friends, hope this has been a good comparative exercise for multi-cap funds. Thanks for watching this video. Watch this space for more such topics. Until then, happy investing.